bond ETFs, continuing to see inflows. This is amazing to me. Total ETF assets under management are continuing to grow. They've got about $4 trillion in US-based ETFs right now, despite the fact that the broader equity markets are up roughly 20% this year. Inflows into stock ETFs, they're essentially flat this year, but investors continue to put money into bond ETFs, which are growing at a double-digit pace. How do you explain that? We have been talking about this for years now. Well, it doesn't make a lot of sense with the levels, with dividends at these levels, and yet they keep putting money in.
Well, if you talk to financial advisors and if you talk to clients, you'll understand why. There's still a lot of fear and a lot of caution in the marketplace. We also do the Global Fund Manager Survey, and this is really looking at professional fund managers on a global scale, and they're very defensively positioned, which is amazing that markets are hitting all-time highs, and the market all year has had a very defensive position. So that's basically the explanation.
So that's the answer. This is part of the whole defensive posturing that fits in with, underweight industrials and materials and overweight utilities?
It's been the pain trade, and obviously we've had a question about the global growth environment, which has made it very comfortable for people to fly into fixed income instruments, and it makes it so. I think that the ETFs around that community do need to have greater access points for people to be investing in munis and AAA credits that actually could be more defensive.
Biggest single question that I get, other than what ETF should I be in, is should I continue to hold on to my high yield ETF? They love that 5 or 6% yield they're getting in HYG and all the other high yield ETFs. Thoughts on this? This is a credit play. If the US economy slows down, the consumer slows down, they're going to be weaker. But what do you tell clients?
So we're still bullish on high yield, especially because we think we're going to stay in a low rate environment. We're not moving towards a recession, so we're willing to take the credit risk to go into high yield. But what's interesting is if you take bond returns on a risk-adjusted basis, they don't look as attractive as equity returns.
Go ahead.
No, that's what we think clients aren't looking at, is their risk-adjusted returns.
10 seconds on high yield, anything?
I tell you what, the JNK and the HYG, if we start to see any questions about the economy, liquidity dries up very quickly in high yield, and I think they will move to the downside.
Good point.